This conference will now be recorded.
Welcome to today's webinar on Wednesday, May 19th, 2021, where we're going to talk about solutions to saving assets from nursing home costs at the 11th hour. So while we are going to be talking about different ways to pay for long-term care and plan ahead, we are really first going to start by understanding some of the practical challenges people are facing today. So no better way, I think, to understand what long-term care is about or who's going to need it than to look at some of the statistics that have been published this last year. So one of the surveys I read said that 70% of people who are age 65 or older are going to need some type of long-term care services during their lifetime. That's a pretty high percentage. The survey also said that 48% of people who are age 65 and older are going to need paid long-term care services. So the difference is that in the 70 percentile of the survey, that care might be provided by family members or friends, whereas in the 48 percentile, the services actually have to be paid for, which means most likely that it's being provided by either a registry or a licensed home health care agency. The next statistic I found interesting said that when they followed individuals who needed long-term care, 24% of people over age 65 needed it for 2 or more years. That was the average. And interestingly enough, the survey also said that the female gender tended to require more long-term care services than men. And that would make sense because statistically speaking, when we look at actuarial life expectancy over decades, women do outlive men. Another important statistic was that 15% of people who are over age 65 can very well end up spending 2 or more years in a nursing home, a skilled nursing facility, compared to in their own private home or in the home of a family member or friend. So if we look at these statistics and we realize that some people have the challenges of being diagnosed with dementia, which any dementia or cognitive impairment may not necessarily have a physical or a medical component to it, meaning the person's cognitive abilities are decreasing, their memory, their recall, the ability to discern things that are safe from things that are unsafe. That is now compounded with the dementia, but not necessarily having any physical condition happening, meaning their organs may be in good physical shape, the heart is good, there's no diabetes. And so in those situations, people with cognitive impairment may very well end up needing long-term care services for a much longer period of time. And we also have to remember the impact that this creates on the people who are the caregivers. You know, in some relationships, that might be a significant other, a life partner, a spouse. It could be an adult child or a daughter-in-law, which we see very often in certain cultures where traditionally it is the daughter-in-law that cares for the aging parent or aging in-laws. And the impact means not just the physical toll on the caregiver, the mental and the emotional toll, but many times it could affect the caregiver's ability to be gainfully employed, either part-time or full-time. So it can also have far-reaching economic effects that we want to be aware of. So when somebody is aging, when there is a medical or a cognitive challenge, it really affects everybody that surrounds them. And I also found it was interesting in reading the survey that only 8% of long-term care services are paid for by private insurance. So that might mean if a person bought a long-term care insurance policy, that's going to pay for home health services, perhaps pay for assisted living care or skilled nursing, or perhaps if somebody were a teacher, they may have great health insurance from the state where they worked. But it's a very low number, which means that all of us need to be thinking ahead and planning ahead so that we're not dealing with these issues at the 11th hour. So when we think about benefits of long-term care planning, we want to also understand what are the different types of services that might be required. What does long-term care really mean? So there is what we call skilled nursing care, and this is considered to be the highest level of medical care that an individual might require. It can only be provided by a licensed medical professional, such as a doctor, a nurse, an RN, an LPN. It could possibly, in a skilled nursing facility, be supported by a trained and certified nurse's aide or home health aide. But usually when people need that high level of care, it's because they're not able to perform mostly any of their activities of daily living, which are things we do now and we probably take for granted. They include the ability to dress ourselves, to bathe ourselves, to groom, to transfer out of the bed into a chair or into a wheelchair, the ability to go to the bathroom independently. So when somebody is not able to do that and they need services in order to be safe in their environment, that's when they're going to need skilled nursing care. Person might also need skilled nursing care if the doctor has given prescription medication, but the person cannot properly self-administer, or if they have cognitive impairment, there's the danger that they won't remember to administer, or they may not take the proper dosage. Another reason while somebody might need a skilled level of care is they may have some very high level requirements. They may have a feeding tube, for example, that carries with it certain risks. So we need a nurse to make sure that it is properly cleaned and maintained. It might mean that somebody has other types of medical equipment. They might have a colostomy bag if there was a surgery and now they can no longer urinate or go to the bathroom by themselves. So those are all reasons why somebody may very well need a skilled nursing level of care. Now, a lower level of care that can be provided in a private residence is home health care. So here the individual is still able to perform some activities of daily living, but perhaps they need some assistance, or they may need to be cued to start the process. So you may go through a registry or a home health agency to have a home health aide or a certified nurse's aide come to your home or the home where you're living at. With individuals that have been diagnosed with cognitive impairment, if at some point in time that the home can no longer be made safe, and safe means we don't want this individual leaving the home and walking down the street and getting lost or going into a canal and drowning. It could also mean that the home is not safe because if nobody else is home to supervise during the day, we don't want them leaving the stove on or a candle, anything that could cause a fire. So it may be that we have to consider perhaps a daycare during the day that specializes in caring for people who need memory care services, or perhaps an assisted living residence that provides memory care services for individuals with cognitive impairment. For people who have a chronic physical illness or disability, something that is going to be prolonged, each individual ages differently, and each person is going to be affected in a different way by their disease process. So they may begin by remaining at home, and from there they may need assisted living, supervised services, or at some point in time, skilled nursing services. So it is possible to go through different stages of residential environments where different long-term care services can be provided. I've found over the years that many clients are under the misbelief that when they turned 65 and they became entitled to Medicare coverage, that Medicare was going to pay for anything and everything they ever needed for the rest of their life that was healthcare related. And that is not an accurate statement. When Medicare was created in the late 50s, it really was designed and intended to pay only for short-term illnesses and healthcare costs. So for example, on Part A of Medicare, you have coverage for when you go in the hospital, whether it's for a scheduled service, whether it's the emergency room. And you'll also get a certain amount of coverage when you leave the hospital if you've had a 3-day admission and you're going directly from the hospital to a rehabilitation facility. Medicare will cover up to a maximum of 100 days. During the first 20 days in the rehab facility, Medicare is going to cover 100% of the cost. The cost meaning the room and board, all the therapy services, the prescriptive medications. Usually around day 20 is when there is a reassessment. They want to see how is the patient progressing. And at that point, a determination is made whether to proceed with the therapies and whether Medicare is going to cover it. If Medicare decides to cover day 21 through day 100, it is only covering 80% of the cost of the services. The remaining 20% is the responsibility of the patient. So here at the beginning of the long-term care continuum, we need to talk about, do you have a supplemental policy? Sometimes it's called a Medicare supplement. It's also referred to as a Medigap policy because it's intended to cover the gap between where Medicare stops and where you would be fully financially responsible. So if you don't have a Medigap policy and you already have Medicare, this is something you want to look into. Now, these policies are regulated by the federal government, meaning no matter what company sells them, it could be United Healthcare, it could be AARP, each policy has to offer the exact same services and coverage. So you want to work with an experienced Medicare supplement insurance specialist who can explain what the different policies are going to cover, and based upon your health condition and your past health history, help you determine which insurance policy would best meet your needs. But what's important to understand is this is just for short-term illnesses. It is not long-term. So Medicare will usually only cover 99 home health visits a year. Anything beyond that is the patient's financial responsibility. Medicare is not going to pay for unlimited home health care services, nor is Medicare going to pay for skilled nursing care services. That is considered long-term. So when we talk about what are the options to finance long-term care, whether we plan in advance or we waited and it's now the 11th hour, the first place I like to start is, did you consider long-term care insurance? Now, like any type of insurance we buy, whether it's homeowners insurance, automobile insurance, the whole reason behind insurance is that should there be a loss, whether it's an accident in a car, whether it's a flood or a fire in the home, the intent is that we are shifting the responsibility of payment from us to the insurance company. So all those premiums that we pay every month and every year have been invested by the insurance company so that when or if that day arrives that we make a claim on the policy, they've been investing those premiums so that they're able to pay on the claim. And it's really no different here with the concept of long-term care insurance. You are making an investment in your future medical care should you need long-term care services. Now, a policy can cover pretty much everything we've been talking about. It could cover home health care services to be provided in a private residence. It could even cover going to an adult day center. It could cover skilled nursing. It could cover assisted living as well. So think about long-term care insurance as soon as you are healthy and you are financially able to consider it, because the older you get, the higher the premiums can be. And if as you age, you start to have changes in your medical condition, it could be too late to be medically underwritten. The thing to think about when you're considering long-term care insurance is the benefits. And to me, the number one benefit is it gives people choice. It gives people choice of where they want to receive the care, rather than being told you can't receive the care at home because you have insufficient income or insufficient assets to pay for that care. Whereas if you bought a long-term care insurance policy that is going to pay for care to be provided in the home, you have the option of choosing to stay in your home or the home of a family member. For those people who did not plan ahead and perhaps it's too late to consider purchasing long-term care insurance, we then need to look at what is that person's savings? What did they put away over the years? How long is this going to last based upon the services that are needed? We also look at, is there a retirement plan? Did somebody put money away in an IRA, in a 401k? Is it possible to now access those retirement monies and apply them to pay for long-term care services? And this is the time when in the discussion, we also need to involve our accountant, because we need our accountant's guidance to determine what, if any, tax impact there could be as a result of accessing the money in the retirement fund, and can we offset it perhaps by a medical expense deduction. If you are a veteran or a spouse of a veteran, then you might have an additional financial option of obtaining certain benefits through the Veterans Administration to help you pay for your long-term care costs. One of the most sought after programs is called the Aid and Attendance Program. And the reason this is so highly sought after is the veteran does not have to be injured during wartime in order to make a claim. Simply, the veteran can say, as part of my aging process, I need assistance to be safe in my home environment. Now, the VA does have financial eligibility requirements to qualify for aid and attendance, and it does consider any out-of-pocket medical expenses that the veteran is paying him or herself that are not covered by health insurance. So the lower the income is, the more medical expenses that the VA sees are being incurred generally lead to the conclusion that the VA says this veteran needs financial assistance. And they will then, through a math calculation, determine the amount to be paid each month to the veteran. Now, I said a minute ago that a veteran spouse might also be eligible. But what has to happen first is that the veteran must make a claim. Then the spouse can add a claim as well. Unfortunately, when we see situations where the veteran is healthy, does not need any aid and attendance benefits, but it's their spouse who has either a medical condition or cognitive impairment, unfortunately, we cannot apply for the spouse because the spouse's entitlement is directly connected to the veteran's entitlement. Disability compensation is a different program, and this does require proof that the veteran was injured during their service. So we have to show the connection between the injury and the current disease process. If you are a veteran or you know of somebody who's a veteran, there is also the option here in Florida, if skilled nursing is required and cannot be safely provided at home in a private residence, we do have several veteran-administered state nursing homes. Here in Broward County, we have one in the south part of the county in Pembroke Pines. It is highly sought after, and over the years I have seen that there can be a waiting list. So again, the message today is don't wait till the 11th hour, don't wait till the last minute, but start to look into these things early so that you are more prepared. Now, for people that are married, we always have to consider and find a way to accommodate not just the needs of the spouse who's ill, but the healthy spouse as well. So here the goal in mind is how can we access different assets, different government federal programs, while maintaining a certain level of assets for the healthy spouse for their future medical needs. So now we're going to talk about the program called Medicaid, which is a federally funded program, and we on a state level contribute as well. So about 48 cents of every dollar is contributed by the state of Florida. So to qualify for Medicaid, you must not only meet certain medical criteria, but you have to meet certain financial requirements as well. Now, the reason for this is because Medicaid, similar to Medicare, both programs were created in the late 50s. And back then, we really did not have developed the middle income class. We had a wealthy class of individuals and we had poor. Poor was considered people with low income, low assets, and who did not have the opportunity to either pay for health insurance privately or it was not available to them through employment. So for this reason, Medicaid was intended to help that class, whereas it was expected that people who were wealthy were going to be able to independently finance all their healthcare needs. So that's why there are these financial eligibility requirements to qualify. Now, the figures we're going to talk about today are only good for this calendar year. Every December, the agency will announce what the new eligibility requirements are for the next calendar year. I will share with you that one of the figures that has never changed as long as I've been in practice is the amount of countable resources that an unmarried person can have and qualify for Medicaid. And that has always been at the level of $2,000. If a person is married, their spouse who does not need the Medicaid assistance is able to have up to $130,380. Now, many people, when they hear these numbers, immediately get upset and think, wait a second, this is barely anything. How is somebody expected to live? So let's talk about what is considered countable, and then we're going to talk about what is not countable. So countable resources are things such as our bank accounts, our checking, savings, money market, certificates of deposit, treasury bills, treasury notes. That is what is countable. So that's what we focus on when we're trying to help somebody who is in need of long-term care services. Now, Florida is only one of 14 states left in the country that is still applying a monthly income limit as part of its eligibility requirements. And when I say monthly income limit, that means all sources of income. So if a person is retired, it means your Social Security retirement benefits, pension, interest income. If you are receiving an IRA distribution or a distribution from an annuity, which is an insurance product, that is all considered income. And we have to look at it. We have to look at the gross amount, meaning before there's any kind of deduction for taxes or health insurance premiums. And we have to see, is the gross income less than or greater than the amount that Florida has set, which for this year is $2,382 a month. If the gross income is less than this figure, great. That's the end of that inquiry. However, if the income exceeds $2,382, then in order to qualify for Medicaid, there are additional steps we need to take. And the attorney will need to prepare what is called a Medicaid income trust. This is a legal document that then leads to setting up a bank account in the name of the income trust. And the bank account every month is going to hold the amount of the excess income. Then from that account, that money will be paid out for care, whether it's to a home health agency or perhaps a skilled nursing residential facility. So we have to look very closely at all the income and all the assets to determine what needs to be done in order to help somebody qualify for Medicaid. Now, although there is an asset, a resource limit for a spouse, in Florida there is no income limit for a spouse. In fact, it's just the opposite. Florida sets a minimum level of income that it feels the spouse should have, and if the spouse's income is lower than that, then they will allow income from the ill spouse to be shifted over. One of the most important things to be aware of, and this is something that is also not well understood, is that Medicaid has a law which we refer to as the 5-year look back for transfers. On a Medicaid application, you will be asked the question, have you transferred or given away any of your assets in the last 60 months? If you did, you have to answer yes, because if you say no, that's considered Medicaid fraud, which is a crime and it is punishable by a fine as well as in prison. So you need to be honest and answer the question correctly. If assets were given away, then the next question asks when, what's the time period, and what is the value of the assets that were transferred. So any assets transferred within 5 years of applying for Medicaid assistance is going to create a delay in being approved for Medicaid. We sometimes refer to this as a penalty. So it's not a financial penalty, it actually is a period of time that the person applying is not eligible for Medicaid. And that could be days, weeks, months, years, or any combination, depending on how small or how large the transferred assets were. Now, here in Florida, I think that we are one of the better states across the country that offers many different exempt resource options. So exempt resources have a value to them. We know they do, but Florida Medicaid is willing to not count their value. So they can be kept and the person can still apply and qualify for Medicaid assistance. The first and probably the most important exempt resource for any individual is their home. Now, up until about 10 years ago, there was no limit put on the value of the home, and that was changed by federal law, which all states had to implement. So the figure for this year, and it will change again next year, the limit on the value of the home is $595,000. As long as the home is valued at less than that, the entire home is an exempt resource. If the home is valued greater than $595,000, then Medicaid will count the amount that is over that set limit. Now, you can reduce the value by showing that there's an outstanding mortgage. We're also allowed to deduct the cost of repairs and improvements. This is actually one of the first areas we look at if a person has countable resources that would disqualify them for Medicaid. So let's say there's a mortgage and we have excess cash or other types of liquid assets. We might want to pay down or pay off that mortgage, or we might want to make repairs and improvements because it achieves two goals. The first goal is we just lowered the amount of our countable resources, bringing us closer to qualifying, and we simultaneously just increased the equity value of our home, which is a non-countable resource. So that's really a win-win approach when we have to help somebody that needs to qualify for Medicaid. Do be careful about what you hear from friends, neighbors. Be careful about what you read on the internet. There still tends to be a lot of misinformation about the home. And what I hate to see people do is rely on misinformation and do something that actually harms them, which is either selling their home or transferring their home. Because what happens if you transfer the home is it goes from being an exempt resource to being a countable resource. Or if you got no value in return, let's say you transferred it to somebody in the family, well, that's a transfer of asset that's going to incur a penalty, which means you're going to be delayed qualifying for Medicaid. So that is not the right approach to take. Now, if somebody's still able to stay at home, I wouldn't recommend selling it because then we have cash proceeds and now we just increased the amount of countable resources that you have. So there are always little exceptions written into the Medicaid federal law. That's why you want to work with an experienced elder law attorney so you learn about these nuances and you find out, will any of these apply to me in my situation to help me qualify for Medicaid? So an example is in the federal law, there is an exception that says if there was a child who was a caregiver, they help take care of the parent for a period of at least 1 year, and it can be documented, it can be proven. And we usually do this through an affidavit signed by the parent, an affidavit signed by the caregiver child, and an affidavit signed by the treating physician. Then it's permissible for the parent to transfer their home to the caregiver child, and it does not result in a penalty. So that's an example of a proper way to go about doing this without it causing any delay in qualifying for Medicaid. Another type of exempt resource that we can consider is called income producing property, and it's just a fancy way of saying rental property. So if somebody has excess resources and they need to spend that down in order to qualify, we might explore having them use the money and purchase rental property. The Medicaid rules say if a reasonable effort is made to rent it, and that could be seasonal based, vacational based, or all year round, then that income producing property value is an exempt resource, but they will look at the net rental income that's being produced. So if you remember, we talked a little while ago, Medicaid will look at income in Florida, and so it's that fine balance of the scales. We might make something exempt on one side of the scale, but it might create income on the other side. So we look to achieve the best balance possible. Another type of exempt resource is a car. So the person applying can have one car regardless of age or value. A second car could be kept and not counted if it is 7 years of age or older. Now, you heard me say that Florida has some very unique rules about exempt resources that we don't find in other states. And here's one. We will exempt the value of an IRA or a 401k if the account owner is taking monthly minimum distributions, not annual, monthly. Now, I know for anybody listening that you might be saying to yourself, but wait a second, my accountant told me that I can just take one distribution in December and it represents 12 months of the year. And that is true. You know, when we look at it from a tax perspective of what the tax laws require. But when it comes to the Medicaid rules, Medicaid wants to see the distribution taken monthly. So it's a very simple process of contacting the administrator for the retirement plan. They will have you complete a change of distribution form so that your distributions are converted from annual to monthly. And by doing that, you will very easily exempt the value of that retirement plan. Now, when the federal laws changed many years ago, one of the major changes was made to the annuity rule. So an annuity is an insurance product where you pay a certain sum of money to the insurance company as an investment in exchange for their promise to repay it over a period of time with either a fixed rate of interest or a variable rate of interest. And should you not survive to receive all of your investment back, you can designate beneficiaries to receive what's left. Well, when Congress decided to change this rule because there was the perception that people were putting money into annuities not so much for having an income source when they retired, but doing so in order to qualify for Medicaid, they created a new requirement. And that new requirement is that if you are married, you can designate your spouse as the first beneficiary, but the state that is providing the Medicaid assistance must be named as the second beneficiary. So here we see where the states are trying to recover Medicaid benefits paid at the death of the Medicaid recipient. If the annuity owner is not married or their spouse has passed, they cannot name their children or any other family member as the primary beneficiary. They must name the state Medicaid agency as the first beneficiary and then the family as second beneficiary. So we really look at this very carefully to determine, is an annuity the best planning option for you when we look at the totality of your situation. Now, while it's never comfortable to talk about needing to make funeral arrangements, here's a reason why I suggest it. Believe it or not, Medicaid is going to ask this question on an application. And what Medicaid wants to know is, what is the value of the funeral plan? And if the plan is irrevocable, meaning you can't get any money back, you can't get a refund, then they will exempt that funeral arrangement. So for those of you who have made funeral arrangements, you may want to, after this webinar, pull out your funeral contract and read through it, or contact the funeral home and see, is your contract irrevocable? If it's not irrevocable, Medicaid's rule is you are limited to spending no more than $2,500 on the arrangements. Whereas if you make the contract irrevocable, there's no limit at all. So we have many more options available to us for exempt resources, and one of the options that is available to people under age 65 is called the Special Needs Trust. Now, this is something that we use with younger individuals, either because they may have been injured in an accident and they received a personal injury settlement, or perhaps somebody in the family died and left them an inheritance. So in order not to lose their Medicaid or their SSI, we put that settlement or that inheritance into a special needs trust. We inform the Medicaid agency what's been done. And as long as the trust agreement says we are going to pay back to Medicaid at the death of the Medicaid recipient, anything that might be left in the trust, it is accepted by the Medicaid agency. And what's really nice for the Medicaid recipient is the monies in the special needs trust can be used to supplement and enhance their quality of life and quality of care. So there are limitations in the Medicaid system as to what's going to be covered and what's not. And so the special needs trust assets add to what Medicaid already provides. For some people, it might be having a private duty aid. It might be traveling to another country for what's considered to be experimental surgery, such as stem cell therapy. It might be going on a vacation. You know, it doesn't have to just be medical or health related. We're talking about enhancing people's quality of life. And that's going to be defined differently for every person. It might be a computer. For a young child, they might need private tutoring. And as I mentioned, a vacation. So a special needs trust is one type of exempt resource. Another type of trust that is exempt is called a pooled trust. Now, this is slightly different in that it could be used for an individual under age 65 as well as over age 65. However, in the last week and a half since I wrote this webinar, there is a change going on in the state of Florida. And Medicaid is going through a legal process to try to change this rule. And its intent is to change the age limitation. Currently, there's no penalty if you're over 65 and you put your assets into a pool trust and then apply for Medicaid. But what our Medicaid agency is now trying to do is to change that rule and say if you're over 65 years of age and you transfer your assets to a pool trust, you will be penalized, meaning there will be a delay in when you will qualify for Medicaid assistance. So if you're coming close to that age and you think you may need Medicaid, this is something that needs to be explored very quickly before the law changes. Now, there are a lot of similarities between the Special Needs Trust and the Pool Trust. Both of them have the goal of enhancing the person's quality of life. Both of them require the payback at death to Medicaid. However, with a pool trust, an individual cannot serve as the trustee to administer it. The law requires that the trustee be a charity, a not-for-profit corporation. The other difference is that at the death of the Medicaid recipient, not only can there be the option of payback to Medicaid, there can also be an option to distribute what's left to a charity. And two pool trusts that I know of in the state of Florida have an arrangement that's approved by the state Medicaid agency that allows for possible distribution to a beneficiary, meaning other than Medicaid and other than the charity. Another very creative type of exempt resource Florida recognizes is called the Personal Service Agreement. Now, this is an arrangement between two people, one being the caregiver, the care provider, and the other person being who receives the services. So here in a contract, we are outlining what are the services that the care provider is delivering over the lifetime of this individual, and how are we valuing them? What is the hourly rate? We also have to determine what is the actuarial life expectancy of the person receiving the services, because we're actually carrying this calculation out over the person's actuarial lifetime. Whatever that value comes out to be is the maximum amount that can be paid to the care provider without it being viewed as a transfer of asset causing a penalty. So in exploring this as an option, where we start is by having the caregiver keep a log for a couple of weeks, write down everything it is that they are doing, whether it's cleaning the house, doing food shopping, doing meal preparation, laundry services. It could be doing things to take care of the house, taking care of the lawn, the car, perhaps bill paying, bookkeeping. So we want to gather everything that happens on a recurring basis, everything that repeats. And then we're going to look for hourly rates that are within or perhaps less than hourly rates paid to professionals in the community, unless the person who's the care provider has some sort of a qualification. Maybe they themselves are a nurse or a home health aide. Well, then we could justify paying a higher hourly rate. Or if they have a financial background, we might be able to provide a higher hourly rate for the financial management services. So if this is a viable option for you, then we create the contract, which needs to be signed by the recipient as well as the caregiver. So we always want to be prepared for unexpected events. And in thinking ahead, it's really important, and ideally we want the recipient to be competent in order to sign the contract. But what do we do if the recipient of these services is not competent? Well, we want to make sure that that person has a very well-written, durable power of attorney that would allow somebody who is in that fiduciary role to sign the contract for them. Without a good, durable power of attorney, this probably will not be a viable planning option. So I want to take a minute and to share with you something that has really popped up the last few years in the state of Florida, And we call this the unauthorized practice of law. And the unauthorized practice of law means that somebody other than a licensed attorney is providing legal advice to a consumer who is then acting on that advice. And the danger when people do this, and we've been seeing people who are financial advisors doing this, even accountants, and then people who have no background whatsoever in the Medicaid area, the danger is that the consumer is not receiving complete or correct advice, and many people are being injured and finding out that they don't qualify for Medicaid when they thought they would. And so not only are they being injured by not qualifying for Medicaid, they've also paid these people money to help them get qualified, and now that money is lost. So be very careful. Don't allow yourself to be in a position where there's a middle person, somebody between you and the elder law attorney. You want to have a direct and independent relationship with your lawyer. Nobody else other than you and the lawyer should be making decisions about strategy, and nobody other than the lawyer should be preparing any legal documents. How are you going to know if perhaps you're being approached by somebody who's not an attorney? Well, here's what you're going to look for in the advertising. You might see in a newspaper or even on the cars that are wrapped and they're driving through the neighborhood, symbols that give you the sense that somehow they're associated with the federal government. A symbol like the American flag, the American eagle, a symbol that would show a connection to a veteran. It gives a very false sense of reality that somehow they are official and they know what they're talking about. Unless that person shows you that they are accredited in writing by the Veterans Administration to be able to provide advice about veteran benefits, you want to run the other way. So that's an example of what to look for, so you're careful. A couple of years ago, we had to go in front of the Florida Supreme Court with clients to testify and explain how consumers were being injured. And one of the most frequent injuries was that these people who were not lawyers were not telling the consumer that if they liquidated an investment, there was a tax consequence to it. And then they'd find out later when they got the tax bill from IRS. Or things weren't done timely, and so there was a delay in Medicaid approval, which meant that they owed a debt to the nursing facility. Or there was a very extreme case where a daughter was advised by a non-lawyer to say that she was providing personal services to her mother, and this non-lawyer wrote a personal service agreement which the daughter signed. And when the application was being reviewed by the caseworker and the legal department, they learned that the daughter in fact was not providing any services to the mother, and the daughter was charged with Medicaid fraud. In addition to the daughter being charged with a crime, the mother was not approved for Medicaid, and the Department of Children and Families decided that they would never approve her for Medicaid, even if she reapplied in the future. So these were some pretty serious, egregious situations where consumers have been taken advantage of. Another example is somebody not knowing all the rules and not identifying all the income sources, and lo and behold, you file an application and the caseworker says you're over the income limit. Where's your income trust? But you don't have one. So you're late getting that done, which means you're delayed in being approved for Medicaid. Or you don't identify on the application all the resources. Well, guess what happens? They're going to run your Social Security number through every single government database. And even if you don't identify an asset on the application, they are sure to find it. And If that happens, they're going to ask you if you intentionally fail to disclose the existence of that resource on the application. So these are real life dangers that have happened to other people that you don't want to happen to you. So in closing, I want to give you a few tips to think about. Know that there are solutions to aging challenges. Ideally, we want you to plan ahead when you're healthy and when you're competent, because you're going to have more planning options. You're going to avoid expenses that occur when you wait till the last minute and it's an emergency. And you're more likely to be able to preserve your privacy. And what I mean by privacy is if we don't have a good durable power of attorney to work with, then the next option is first we have to go to court and do a guardianship in order to do long-term care planning. And in the court system, many documents in a guardianship are considered public record. So anybody can view them by sitting at home on their computer. You don't even need to go to the courthouse anymore. So ideally, we want to preserve privacy. It's also, as I said, important that everybody who's an adult has a good durable power of attorney for financial decision making, should they become incapacitated, and a good, well-written designation of healthcare surrogate for medical decision making. This is not the time or the place for you to attempt to do it yourself. That is for arts and crafts, but not for legal planning and not for long-term care planning. So at this time, I'd like to open it up to any questions. You're welcome to unmute your microphone, or you're welcome to write a question in the chat box, which is located in your upper right corner of your screen. Well, if there are no questions, I'd like to thank everybody who's joined me today. And please remember to look at our calendar on our website to see the upcoming webinars. And if you registered but something came up last minute and you missed it, we do post the recordings about 48 hours later. You can either go to our YouTube channel or our website to watch the recorded webinar. And on the website, we also have a gift certificate for a 20% discount on an estate planning consultation or a long-term care planning consultation. So I hope everybody has a great week, stay healthy, enjoy your summer, and I look forward to seeing you soon.